What's up everybody, I'm Jaspreet Singh, and with inflation breaking record highs and the Federal Reserve Bank wanting to bring inflation down to quote normal levels of 2 to 3%, have you ever wondered why 2% is considered normal inflation? Inflation has been around forever, and if the Federal Reserve Bank can control inflation, why do we want any inflation at all? Anytime we have inflation, whether it's 1% inflation or 10% inflation, it makes regular people poorer because the inflation eats away at the value of your savings and your earnings, so why don't we just have zero inflation? Well, it's a little secret that really isn't a secret anymore, that inflation disproportionately benefits some people while disproportionately hurting others. Like inflation disproportionately benefits asset owners and investors, because if you are an investor and you own assets like real estate, or you own stocks, or you own a business, inflation benefits you because now the price of your real estate goes up, the price of your stock portfolio goes up, the price of the things that you sell go up, so your revenue goes up. So if you are an asset owner, you are a producer, you are the investor, inflation benefits you. It also disproportionately hurts the middle class and the poor, because now if you don't own many assets or any assets at all, and you only have some savings and you're relying on your job, your salary in order to survive, well, now your salary doesn't stretch as far because your cost of living is growing faster than your wages, and your savings that you work so hard to put aside now keep losing its buying power each and every day. So you're slowly becoming poorer each and every day, even though you're working hard at your job, you're working to get a raise, but sometimes your raise doesn't keep up with inflation, and you're working hard to put some cash aside in your savings account, but your savings are losing buying power each and every day. But there's one more entity that benefits from inflation that most people don't talk about: the government. This is how most entities operate. Revenue minus expenses equal your profit. And so if you're a business, you need more money coming in than it's going out, and that's how you have a profit. If you run a business where your expenses are greater than your revenue, well, you're not going to be in business much longer unless you have a way to counterbalance these higher expenses. Maybe you can get an investment from somewhere, maybe you can go out and raise debt from somewhere, but eventually you're going to need more revenue than expenses in order to stay in business because you need a profit. The government works similarly, but a little bit different. They don't actually sell a product in order to make money. Instead, they get their revenue from taxpayers through tax dollars. So you work hard and you generate an income, and then the government taxes that income. That's how they get their revenue. So this is their tax revenue, and then they have their expenses just like anything else. They pay for things. They pay for teachers and police. They pay for infrastructure. They pay for their growth services. They pay for whatever it is that they want to do. And then if there's any money left, there's a profit. However, our United States government is not running a profit. Instead, they're running a deficit. That's why we have a $30 trillion national debt right now. So what that means is the government has spent more than $30 trillion than they've brought in from their tax revenue. Now you got to think about this, because if the government is spending more money, they have higher expenses than they do revenue, how are they going to cover this higher expense? Well, this is where now they can work with something like the Federal Reserve Bank, who then prints this money and loans it to the United States government. So now the government has the ability to spend this money however they want. They can continue running their operations, but then what happens is their national debt starts to go up. Your debt payments also rise, because just think of it like your credit card. When you keep swiping on your credit card and your credit card balance increases, your monthly payment is going to increase. Now that monthly payment that you're going to pay is going to depend on two things. It's going to depend on how big your credit card balance is, and second, it's going to depend on interest rates, because your credit card balance is a variable interest rate loan, and as interest rates change, your minimum payment is also going to change. Now this is where things get really interesting. It's going to get a little bit confusing, but just stick with me because I'm going to try to break it down as simple as I can. If the government has $30 trillion worth of national debt, that's a lot of money that you got to pay back. Well, what's the easiest way to pay back this national debt? Either you're going to have to raise the taxes of your citizens, or you're going to have to cut the expenses, meaning some of the benefits of your citizens. Both of these things are going to make people upset, because if we raise your taxes, well, now less of your income is going to actually make yourself wealthy. It's going to the government. If we cut your benefits, you're going to be upset because now you're losing your Social Security, you're losing your welfare. People get upset. And so what the government can do, the third option, is they can try to inflate their way out of this debt. So what that means is, if you have a certain amount of money that you have to pay back and inflation happens, meaning the value of the dollar drops, well, now this debt becomes less burdensome because now it's less valuable, right? If inflation happens and you have $10,000 in the bank, well, that $10,000 loses value anytime there's more inflation. That's why $10,000 could buy you way more 10 years ago than it can today. $10,000 could buy you way more 30 years ago than it can today. And $10,000 could buy you a whole house 100 years ago. I guess you could also buy a house for 10 grand back during the 2008 crash. But if you remove that, you could buy a house for 10 grand 100 years ago. So the government wants inflation because that makes its debt burden less. This is why the Federal Reserve Bank says that it wants to have a healthy amount of inflation, something like 2%, maybe 3%, instead of having no inflation, because if you had no inflation, well, then that debt burden wouldn't be getting less. But this is where now it becomes tricky, because when you keep creating more inflation, then it can create an inflation problem. Now you build an inflation bubble. This is what we've been doing for decades now, because we've been printing money, we've been creating inflation for so many years. And now we're really starting to face the price of that, because now this inflation is catching up to us, and we're seeing that the inflation is now hurting the economy. And so if the economy is slowing down, that means people are making less money. That means businesses are making less money. And if people and businesses are making less money, that means there's less taxable income. That means revenue for your taxes go down, because now if you lose your job, you no longer have an income that gets taxed. If a business makes smaller profits, well, then they're going to be paying less tax. And so if your tax revenues go down while your expenses are going up, or even if they don't change, well, now you have less revenue to pay for these expenses. Now you might say, well, the previous solution was just create more inflation, just print more money. However, the issue with that now is we're already facing an inflation problem. The reason why we got into this mess in the first place is because we printed so much money and because we created so much inflation, which then led to the economic slowdown, which then is leading to the tax revenue slowdown. And so now the government's in a tough situation, because now as the Federal Reserve Bank is looking to fight inflation, they have to raise interest rates. And if you're raising interest rates, that makes the national debt more expensive as well, because kind of like your credit card, your national debt that we have, our national debt, is not a fixed rate 30-year mortgage. It's variable interest rates. And a big chunk of our national debt is going to recapitalize every year, meaning that a big chunk of our national debt is going to be subject to the higher interest rates. So now, let's put this all together. If the Fed is raising interest rates to fight inflation, that makes the national debt more expensive by the government, because now the government is going to need to pay more of its revenue, more of its tax dollars to pay off this national debt. Now, at the same time, this high inflation, which has not gone away, is also contributing to a slower economy, meaning that this high inflation is also contributing to less tax revenue going into the government. So the government's going to be getting less tax revenue because the economy is slowing, and more tax revenue is going to be going to pay off this debt, while government expenses haven't really been changing. In fact, the government is still spending more money than they're bringing in. And so anytime you hear of the government wanting to spend more money than they have, you keep hearing of the government wanting to fund more operations. Well, it sounds nice because you get something for free. Maybe it's a free check. Maybe they pay something off. Maybe they give money to somewhere. All these things are nice because you feel like you're getting something, but somebody always has to pay the price. The most expensive money is free money, because now when you print this free money, everybody has to pay the price, and it's primarily paid by the middle class and the poor, the people who are not financially educated, because now everybody pays the price through inflation. So now the prices of your groceries, your gas, your rent, your vacations, the price of everything goes up, your savings become less valuable, your earnings become less valuable. And now we're facing a tougher situation where not only are we facing inflation, but the government has this high national debt. And now the payments on this national debt are going up with the higher interest rates while the economy is also slowing down. So this is something that you want to be paying attention to, because now at the same time, the government is also talking about raising taxes in order to fund more government spending. Why do they want to do this? Because the government wants to keep up with the programs. They want to continue creating more inflation. They want to continue doing what they do. However, there's a price for that. Now, if you raise taxes to pay for a program, it's very clear who's going to pay for it. Whoever is the beneficiary of these higher taxes, which are typically the middle class, no matter who the taxes go after, is typically the middle class who pays the price for these higher taxes. Well, that person is going to be paying for that program. However, most of the time, the taxes don't cover the expenses for the program. So what happens? More inflation happens, national debt increases, and now in a time where we already have such high inflation, that contributes to more inflation, which then slows down the economy, slowing down tax revenue, while causing the Fed to now increase their fight on inflation, meaning raising interest rates even more. So this is the predicament that we're in right now with the government and the Federal Reserve Bank, and this is where now you need to be smarter with your money, because if you're not financially educated, you're going to be the one that's continually paying the price. So this is where you want to be investing in your own financial education. If you want to learn more about how to start generating passive income and how to invest your money, to do that, we have a free guide that I created on how to start generating passive income. You can read this guide for free. I'll put that link for you down in the description below. But this is where you also want to be aware of what's happening around you. That way you can capitalize on opportunities that come your way. So you want to, one, be smarter with your money. Put some extra cash aside. That way you can capitalize on opportunities, because when you have these types of volatile markets, because you can bet this problem isn't just going to magically go away. While the government and the Fed are powerful, they don't have fairy dust to make these financial problems just go away. So you can expect these problems to be around for a while. This creates more volatility in markets, and this creates opportunity then for you as a financially educated investor to come in and buy some of these assets, some of these investments at a discounted price. Like I talked about in the beginning of this video, the people who benefit the most from inflation are the asset owners, the investors. And if you can come in and find a good asset, find a good investment, whether it's stocks, whether it's real estate, whether it's cryptocurrency, whether it's gold, whether it's a business, whether it's a startup, you can find the right asset for you. But now you want to come in and be able to purchase this asset at a discounted price. But that means you got to be prepared, and you got to have the cash, and you got to have the right financial education. And the best time to start preparing for that is today. You want to understand the difference between being able to buy something and being able to afford something, and then spend your money based off of that. Dave Ramsey said it the best. He says that you need to act your wage. And the way that you can do that, the simplest thing that you can understand is my rule of 5 when it comes to your liabilities, which are not necessary to you living your life. And that means in the rule of 5, if you cannot buy 5 of them, you cannot afford 1 of them.